Warren Buffett, the Oracle of Omaha, is known for his exceptional investing acumen and his ability to find high-quality companies that are undervalued, or have significant growth potential. One such company that caught his attention in the early 1990s was the Dexter Shoe Company. Founded in 1957 by Harold Alfond, Dexter Shoe Company was a successful, family-owned business that manufactured and sold high-quality shoes. Buffett, known for his long-term investment approach, was intrigued by the company's solid financials, strong management team, and commitment to domestic manufacturing. During this time, Buffett had already amassed a considerable fortune through his investments in companies like Coca-Cola, American Express, and Wells Fargo. He was searching for another great opportunity to expand Berkshire Hathaway's portfolio. He believed that Dexter Shoe Company had the potential to continue its growth and provide stable returns for years to come. Dexter's reputation for producing high-quality shoes and its strong management team, led by Harold Alfond and his son Peter, made it an ideal candidate for Buffett's investment. The Alfonds had built the company from the ground up, fostering a culture of innovation and dedication to quality. Dexter Shoe Company had a loyal customer base and a long history of profitability. Buffett admired the company's commitment to keeping its manufacturing facilities in the United States, a rarity in an industry increasingly outsourcing to cheaper labor markets overseas. Part 1. The acquisition of Dexter Shoe Company by Berkshire Hathaway in 1993. In 1993, Berkshire Hathaway announced its acquisition of Dexter Shoe Company in a stock-for-stock deal valued at $433 million. Buffett was impressed by the company's management and its ability to remain competitive in a challenging industry. The acquisition was an all-stock deal, meaning that the Alfond family received Berkshire Hathaway shares in exchange for their ownership stake in Dexter Shoe Company. This deal demonstrated Buffett's confidence in Dexter's future and the value he saw in the company. The acquisition was initially celebrated as a great investment by both parties. Dexter Shoe Company continued to perform well in the years immediately following the acquisition, and the Alfond family saw their Berkshire Hathaway shares appreciate in value. It seemed as if Buffett's instincts had once again led him to a successful investment. Part 2. The challenges and decline of Dexter Shoe Company and some of the lessons learned. The 1990s brought about a significant shift in the global economy, and the shoe industry was no exception. Manufacturers in countries such as China and Vietnam began producing shoes at significantly lower costs than their American counterparts, leading to a flood of cheap imports into the US market. This development posed a considerable challenge for Dexter Shoe Company, which relied heavily on its domestic manufacturing operations. At first, the management team at Dexter Shoe Company remained steadfast in their commitment to US-based manufacturing. They believed that their focus on quality, innovation, and customer service would allow them to maintain a competitive edge in the market. However, as the flood of low-cost imports continued to grow, it became increasingly difficult for Dexter to compete on price while maintaining their quality standards and profitability. As the years went by, Dexter's sales began to decline, and the company's once thriving operations started to falter. The company struggled to adapt to the rapidly changing market conditions and the relentless pressure from low-cost competitors. The management team at Dexter was forced to make some tough decisions, including closing some of their domestic manufacturing facilities and eventually outsourcing a portion of their production overseas. Despite these efforts, Dexter Shoe Company's financial performance continued to deteriorate, and the once promising investment began to weigh heavily on Berkshire Hathaway's portfolio. Berkshire's Class A shares, which had been used to acquire Dexter in 1993, grew substantially in value over the years. In contrast, Dexter's contribution to Berkshire's overall earnings continued to dwindle. The decline of Dexter Shoe Company had a significant impact on Berkshire Hathaway, as it represented one of the most significant losses in the company's history. Warren Buffett, known for his long-term investment strategy and aversion to losses, was deeply affected by the decline of Dexter Shoe Company. In his annual letters to Berkshire Hathaway shareholders, he openly discussed the failure of the investment and the lessons he had learned from it. He even went so far as to call the Dexter Shoe Company investment "the worst deal I've made," in a 2008 letter to shareholders. The experience with Dexter Shoe Company taught Buffett and Berkshire Hathaway several important lessons about investing and adapting to changing market conditions. One key lesson was the importance of understanding the competitive landscape and the potential impact of global economic trends on a company's performance. In the case of Dexter, the rise of low-cost overseas manufacturing proved to be a game-changer that the company could not overcome. Another lesson that Buffett took away from the Dexter investment was the need to be more cautious when valuing a company's intangible assets. In Dexter's case, Buffett had placed a significant value on the company's management team and its commitment to maintaining domestic production. While these factors were undoubtedly valuable, they ultimately proved insufficient to protect the company from the broader industry trends that were reshaping the shoe manufacturing landscape. Despite the significant loss associated with the Dexter Shoe Company investment, Warren Buffett remained committed to his long-term investment strategy and continued to search for promising companies to add to Berkshire Hathaway's portfolio. In the years following the Dexter debacle, Buffett learned from his mistakes and made several successful investments in various industries, further solidifying his reputation as one of the world's greatest investors. The Dexter Shoe Company investment also served as a reminder of the importance of humility and openness in the world of investing. By publicly acknowledging the failure and discussing the lessons learned from it, Buffett demonstrated that even the most successful investors can make mistakes, and that it is crucial to learn from these experiences to avoid repeating them in the future. In the end, the Dexter Shoe Company investment represents a rare misstep in Warren Buffett's otherwise illustrious investing career. Although it resulted in a significant financial loss for Berkshire Hathaway, the experience taught Buffett and his team valuable lessons about the importance of understanding the competitive landscape and the potential impact of global economic trends on a company's performance. While it is impossible to determine the exact amount of money that Buffett and Berkshire Hathaway lost on the Dexter Shoe Company investment, it is clear that the loss was substantial. At the time of this video, the loss is estimated to be about $12 billion. Ouch! However, Buffett's willingness to learn from this experience and adapt his investment strategy has ensured that Berkshire Hathaway remains one of the most successful and respected investment companies in the world. Part 3. Buffett acknowledges the investment as a mistake, ultimately leading to a loss of billions for Berkshire Hathaway. As Dexter Shoe Company's fortunes declined, Warren Buffett eventually admitted that the investment had been a mistake. In his 2007 letter to Berkshire Hathaway shareholders, Buffett acknowledged that the acquisition had cost the company billions of dollars in lost value. He wrote, "To date, Dexter is the worst deal that I've made. But I'll make more mistakes in the future, you can bet on that." Buffett's admission of his mistake was a candid and humbling moment for the renowned investor. While he is celebrated for his many successful investments, the Dexter Shoe Company serves as a reminder that even the best investors can make errors in judgment. The investment in Dexter was a rare misstep in Buffett's otherwise illustrious career. Part 4. Conclusion. Warren Buffett's investment journey with Dexter Shoe Company began with great promise. Dexter had strong financials, a dedicated management team, and a commitment to domestic manufacturing, which initially attracted Buffett's attention. The acquisition by Berkshire Hathaway in 1993 signaled confidence in the company's future. However, the subsequent decline of Dexter Shoe Company, due to increased global competition and changing market conditions, led to a significant loss for Berkshire Hathaway. Buffett's acknowledgement of this mistake serves as a valuable lesson for investors. Even the most successful investors can make errors in judgment. The Dexter Shoe Company investment highlights the importance of adapting to changing market conditions and illustrates the risks associated with failing to adapt. While Buffett's investment in Dexter Shoe Company may have been a costly misstep, his continued success and the wisdom he gained from this experience have only further cemented his place as one of the most respected investors in history.